Good afternoon and welcome to the Think Realty webinar series. My name is Rodney. I am the Director of Sales here at Think Realty. We're so glad you joined us. Today we have a topic that I'm sure you're going to be very interested in. What's ahead for the multifamily sector in Texas? A few housekeeping items just to get started. We do have the Think Realty conference coming up next month on July 21st and 22nd in Tampa. I hope to see you there. We're going to have sessions in single family, multifamily, private lending, assisted living, and so much more. So I hope to see you there. Just to let you know, this is recorded. So we will be sending this out to everybody that signed up. There were a ton of signups. So we can send that out and you can watch it at your leisure. If you have any questions during the session, don't hesitate to put them in the chat window. And we'll get to as many of them as we can before our time is up today. So with that, we'll turn it over to Chris Ragland. He's going to moderate today's panel. Chris, welcome to the show.
Hey, thanks a lot, Rodney. First of all, speaking of housekeeping, I didn't know we were supposed to wear our favorite, college or professional sports jersey. So this is totally unfair that you're repping your team here in front of everybody, but
well, my owner is an Ohio State fan, so every opportunity I get to wear something in front of him, I'll do it.
Nice. Well done. You're repping it pretty good here. I like it. That's awesome. I appreciate it. Well, awesome. Well, again, we're going to talk about multifamily specifically in the state of Texas, and what does that mean for investors, owners, operators, whatever we'd like to get into and kind of see where this takes us. I'll do a quick round of introductions. Again, my name is Chris Ragland. I am a multi-generation Texan. I've been a real estate investor for about 25 years now, both on the equity and the debt side. So I've kind of seen both sides of this marketplace change over some decent amount of time. Right now, I'm an operator. So I'm actually an operator investor. I purchase multifamily properties, do renovations, and then manage those. I do that for myself. And I do that for other investors. So today, that's probably the hat that I'm going to wear, is the perspective of the operator, those that are out there making the deals happen. So I'll let Travis and Robert introduce themselves. Travis, you want to take it away? Tell us who you are, where do you work, what do you do?
Sure. Thanks, Chris. Happy to be here. Thanks, everyone, for tuning in. Travis Watts, full-time passive investor. I'm a limited partner in multifamily syndications, also the director of investor relations with Ashcroft Capital. Ashcroft Capital's got over $2 billion of apartments, 12,000 plus units. We've transacted over 50 apartment communities throughout Texas primarily, and Florida and Georgia as well.
Awesome. Very cool. So that makes me feel pretty small time over here. So at least we know who the heavy is on the call. All right, Robert, what about you, sir?
Hey guys, how are you? Hey, it's Robert Martinez with Rockstar Capital. I got started in real estate in January of 2007, so I've seen the recessions, I've seen COVID, I've seen the fracking crisis. I'm ready for what's about to happen right now. I guess my claim to fame is that I'm a two-time national owner of the year, the most recent Texas independent owner of the year. Our company's up to about 4,500 units, and tomorrow we close on our largest acquisition of 70 million, which will put us to just under $670 million.
Man, that's exciting. Well, that's cool. Well, very cool. Awesome. Thanks, guys. And thanks everybody who is listening in, whether you're here listening to us live or you're in the future and you're going to be listening to this as a recorded webinar. We're kind of doing this as a little bit of a fireside chat, talking about what's going on, again, specifically in multifamily in the Texas real estate market. So I've got a couple of questions, and let's just start off with a real basic one. And Travis or Robert, either of you would be qualified to talk about this, but we're working with a couple of different organizations here. Think Realty and its sister company, American Association of Private Lenders. So many of those people who participate in those ecosystems, they work in single family residential investing. So today's about multifamily. So my first question to you both is, why specifically multifamily? Why not just go out and do a bunch of single family houses and build a portfolio? Why do you like multifamily over other asset classes?
Yeah, I'll answer that first if that's okay. First of all, you diversify your risk. In a single family, you're only moving one unit in at a time. That person moves out, you're 100% or you're a zero. In multifamily, doors is very important. The more doors you have, the more opportunity you have, the more chance of growing. You cannot grow your equity also with single family like you can with multifamily. You know, a $10 rent bump on a 200 unit property on a 4 or 5% cap is going to be something like $400,000 to $600,000 in new value. You can't do that by just bumping your rent up $10 on a single family house. So those are the biggest secrets. If you're trying to create wealth, and I'm talking real wealth, like generational wealth, you know, I probably started with a net worth of under $1 million when I got started in real estate, and now my net worth is, you know, approaching 100 million. You know, so you're going to get that through investing in multifamily because you have more doors. So, you know, when there's a recession, when there's something, you can withstand that better. You know, if you only have a couple of doors or even like a little fourplex, you can lose half of your clientele overnight, you know, because if something happens. So I think diversity and just the ability to just generate more money, deploy more money at one time than you can to a single family, and then, you know, triple X that, quadruple that, whatever the number is, you make a bit more.
Awesome. Travis, what do you think?
Well, great points, Robert. And yeah, I started out with single family like a lot of people do. I did vacation rentals, used to do fix and flips, and it just got to be a job. Long story short, I burned myself out. I was in that about 6.5 years straight, and I was a W-2 employee at the time working in the oil industry, and it was just too much to take on. And I think a lot of people hit that hurdle as you get to 5, 6, 7, 8 properties, and all of a sudden it's like, man, I have less and less time. I have less and less freedom. So that's what prompted my shift. To add to Robert's points, I mean, cash flow plus equity upside, both built into one asset, is kind of what I look for and what stood out to me when I realized multifamily syndications and the value add space were giving me about the same, if not a better return as a limited partner than doing my own active deals. That was my eye opener. And, you know, it's an essential asset class. It's not speculative like we're seeing all the speculation get crushed right now this year in 2022. Crypto, NFTs, tech stocks, unprofitable companies, you name it. Multifamily and real estate in general is an inflation hedge, so that's nice too. I look at it too, just truly at the end of the day, it's a feel-good business. If you're making a community a better place, you're making it a safer place. I feel better about investing in something like that as compared to just owning some random shares of who knows what and some index fund. And last but not least, the tax advantages are pretty awesome, and it's tough to beat that.
Yeah, indeed. So I agree with the points that both of you made. So, but let's talk to maybe some of the people who are listening who are traditional single family investors making that jump. At the same time, what do you feel is one of the most important things or that's different from managing single family when you make that jump into multifamily? Like for me, I'll tell you my biggest difference was the operating team, right? There were a lot of things that we could do differently in single family asset class. When you make that jump into multifamily, it's like your professionalism and how you manage those properties and the team behind you, it just takes another jump to another level. That was the biggest difference for me. What about you guys?
Robert, you want to start?
Yeah, you know, I think first of all, you're not alone. You know, you're alone if you're buying like a 15-unit deal. But if you're jumping up in scale and you're getting at least 50 units, well, then you bought a property manager. You get your 80 to 100 units. Now you have elite maintenance outside. So you're not alone to do everything. In single family, you are the fix-it man. You are the guy leasing. You are the guy collecting rent. You're doing all that. So as with scale, because you have doors, you can afford to pay for staff. Now, what quality of staff are you going to get at 50 units and 100 units versus a deal that's 300 units? There is a difference there. I remember when I joined the multifamily world back in 2007, I honestly thought it was a talent-deprived world. I really did. But it's because I was buying Class C deals, you know, and they're only like 115 units. So I was getting somebody at 40,000 a door. I didn't realize that all the talent was at Camden. All the talent was at the big players where they have better benefits. They have larger scale. So that talent gap, the ability to bring people in, continues to grow.
Yep. Yeah, I definitely agree with that too. So let's take it to the next question. And okay, we like multifamily. All three of us are. That's why we're here today. Why Texas? I know we're all three of us are call it regional. We're in different different areas, but why Texas in particular?
I'll start with that one. So I started with investing solely in Colorado, and that's back when I was in single family homes. And something I started thinking a lot about is while it may have been a great market, and it was in 2012, 13, 14, 15, as a lot of markets were, right, as the market's recovering, I fully recognize that it may not always be a great market, and I don't want to be a one-trick pony in one spot. And so for me as a limited partner, I was seeking that diversification on a national scale. And coincidentally, most of my money went into Texas deals, and it also went into Florida because we've kept a residence in Florida and just Sunbelt regions in general. Couple quick stats and facts. I've put the majority of my capital in the Dallas-Fort Worth area. So, we saw a 15.4% rent growth in 2021 compared to the national average of 11.4. So exceeding those metrics. They exceeded the annual population growth. So it was 1.8% in DFW compared to 0.6 nationally. And then the job growth was 1.3% compared to the national average of 0.02. They've brought in over 1 million people to DFW, plus I think it was over 100 headquarters either relocating or established in the DFW market over the past 10 years. So it's just been one of those growing, diversified, expanding markets. I can't speak to all other markets in Texas. I've done some San Antonio and Houston and other spots, but I don't know a ton about them. So that's kind of my take on it.
Got it. Robert, what do you think, man?
Yeah, the number one thing that I want is I want to be left alone to operate my business. And as I said, I'm an operator. I'm a 2-time national operator of the year. And I think I've achieved that because I'm in a state like Texas where it's pro business. It's landlord friendly. When I got involved in real estate in '07 and I was in the recession, I learned landlord lien laws. I learned to go knock on doors and go collect that rent. And so when COVID came around and they didn't want to pay their rent, and I'm seeing brand new BMWs and brand new Samsung boxes by the trash receptacles, I knew they had money, but they weren't paying it because of the eviction moratorium. Well, that doesn't mean you don't have to pay your rent. So I went in there with my team, with the landlord laws, and we leaned property. And believe me, we got people to pay $4,000 and $5,000 balances off just because they wanted their $1,000 TV back. That is the kind of environment I want to operate on because that's how I'm going to get the best returns. Yes, Dallas has great rent growth because they have a great financial market. Texas has been oil. We've never seen double-digit rent growth in Houston until recently. And we're probably going to get it again next. I know we're going to get it this year, and we're probably going to get it again last year. So I think being in Houston specifically has made me a great operator because I've had to go through the ups and the downs versus a market like Dallas, which has had double-digit rent growth or if not high single-digit rent growth for a long time. But it's not just me that likes Texas; it's the businesses. You got Tesla, you got other companies coming here, you got Joe Rogan coming here. They like the environment of being left alone. So when those big businesses come, that only helps Dallas. That only helps San Antonio. San Antonio's on fire right now, by the way. Houston, Austin. It's a great area because of the spirit of the state. We're going to leave you alone. You operate the way you need to. We're going to tax you, and we're going to get it on property taxes. We're going to leave you alone. Florida is another great example of that. So you want to go where it's a red state. I don't have any deals. I don't even look at blue states. It's going to have to be in the southern states for me to go and consider operating there.
Got it. That's really interesting. So you both agree, and I do too, that the kind of business-friendly environment lends a lot to why Texas. And that applies to other states as well. And then just generally speaking, the strength of the economy that's here. It was interesting for me to look at, they broke down GDP for last year by state. And Texas is the #1 GDP state in the union. That hasn't always been true, but it's certainly true right now, thanks to the diversified economy and a lot of the energy sector that's kind of booming right now in Texas. So yeah, you're right. As long as we're creating jobs and we have a strong economy and you have a government that's favorable towards businesses, it's going to be a great place to be an investor in Texas. And I think Texas is kind of hell bent on remaining that way. So let's talk about the deals that you see. If it's so good, I would anticipate there's a lot of competition, right? There's got to be a lot of people here picking over deals. So what kind of deals are you seeing right now, considering everything?
Robert, you want to start with that?
Yeah, look, right now is a really interesting time. We got very aggressive the last several months, and it slowed down this year because of the instability in the market, the volatility of the market. There is, especially right now, there is a discovery time right now on what people are willing to pay versus what the sellers want. It's got even, just right now, we're live on this call, but Chairman Powell just raised the Fed number by 0.75 point. That affects borrowing, and borrowing will affect what you're willing to pay. So I think right now is a very interesting time. We've been transitioning away from our workforce affordable housing into Class A, primarily because I saw what happened during COVID. I had almost zero delinquency in my Class A portfolio, but it was all knocking on doors and my B and C stuff. And that kind of wears you out. And I look back at my career, we all get started on Class C. We all get, because that's the easiest to afford, but it's also the most problematic. And owning Class C and Class B long enough while there is value there will wear you down and slow you down. I'm not interested in unit count, and really, I'm interested in value. I'm interested in what people want to buy later on when I'm ready to sell. So, we're definitely focusing more on the Class A market, but with what's going on in the economy right now, I mean, we're in this deal that we close tomorrow. I've seen my rates move in the 60 to 90 days that I've been in contracts. I've seen increased interest expense, interest reserves. I've seen property insurance, property taxes jumping up, fees, spreads, everything's moving. So it makes it difficult to move forward in the market right now. You just got to really pay attention, and operations is key, because if there is a recession coming, how are you going to handle it? Are you property reserve? Are you getting the renewals you need? Because you only lose in real estate, really, or you're not successful in real estate if you run out of money or you run out of time. So I pity the people right now that are up against their loan window this year, or the beginning of next year, with rates where they're at. But if you can survive and you have plenty of time, plenty of money, you can operate, you can be successful and navigate through those rough waters.
Nice. Travis, what about you? What are you seeing?
Yeah, I agree with so much of that, Robert. I think you hit the nail on the head. It reminds me, just from an investor relations standpoint, a lot of what we saw the summer of 2020. There's a lot of volatility in the market, a lot of hesitation, some investors on the sidelines. But what's different now, to your point, Robert, is the interest rates and what that's going to mean and how high we're going to take them. And yeah, it absolutely affects pricing. And so just speaking broadly about, all the operators that I partner with, there is a slowdown happening. There is kind of a wait and pause, a wait and see. There are deals that are still closing. We just closed one a couple of weeks ago that we've had under contract in the DFW area, but we're out there looking for B plus, solid B, A minus, I would say at times. And that is a shift also, to Robert's point, from years ago when Ashcroft first launched. We were kind of the C plus and the B minus, and big lessons out of COVID, when we saw the eviction moratoriums. And yeah, so true. All right. So we rent and collections and occupancy dipped the most on the C and the C plus and the B minus, and very, very little on the A minus and the B plus. So we look for 200 to 600 unit size apartments. And like I said, we're still closing in Texas, but also in Georgia, primarily over the last probably 8 to 12 months or so. So value add is dwindling down. It used to be we were buying these 400 unit, communities that were 100% value add. Now we're seeing a little bit less, maybe it's 30% value add, stuff like that. It's a lot of these properties have been turned over the last 5 years or so.
Yeah, and the other parts of that too, I want to elaborate on that point that he just agreed with, is that the reason why you want to transition away is you want stability. As I said, it wore me down and slowed me down to buy those kind of deals. I didn't have that kind of mentor to tell me, hey, hurry up and get in there and get into the better asset class. I now know that. I learned that through the recession. I learned that through COVID. I learned that through the variety of cycles that we have. Right now, with inflation going the way it is and rents, at some point, there's a breaking point for that workforce housing guy. Then I'm talking the painter. I'm talking the guy that works at the restaurant. There's going to be a breaking point. And you've got to make sure that you're on top of them, that your collection practices are firm. You've got your resident renewal events. You're focusing all of that right now, because they will seek relief and they will leave you. They're only going to stay with you if they feel the value is worth staying, right? So it's very, very important right now to understand where you're going to be. And if you are going to be workforce housing, I would prefer to be where you're very concentrated in an area. You don't have a huge unit count of portfolio. As you grow that portfolio count, you do want to get into the Class A, because you want a little more stability and more residents that care about their credit and are willing to pay. As I said, during COVID, our Class A portfolio was less than 1% delinquency. I wish I could say that for the rest of my portfolio, but it wasn't. I've got to make it easy on myself and easy in operations to move forward.
Yeah, fair enough. I kind of want to highlight a little bit, and since I'm based in Austin, I do deals in a lot of places, but I do continue to do deals in Austin. And man, there are just some I would call it fundamentals that are really broken right now that are going on. And it's almost like a kind of an experiment is starting to, that's how it feels. For example, I'm watching people buy at like a 2.3 cap, and I'm like, what is happening here? Like the fundamentals of investment appear to be broken, and it's based on just, speculation. They're trying to make it up on the other side. And so far they've been able to do this, right? But that kind of makes it unhealthy, because the other deals that you're not going to get that type of appreciation, they're seeing that as a comp, and they're trying to use that number and say, well, this is what I should be at price per door. And back to Robert's point, workforce housing, like that basically doesn't even exist in the city limits anymore. It's being pushed out to somewhere else. So you have to raise the asset class value to replace those tenants with a higher tenant class that's okay with paying a premium for that property. So it puts pressure on the investor to reinvigorate that property as well. You can't just maintain and be a solid B- or whatever type of a workforce housing class you're going to be able to produce. You are forced to improve that property and to move up river. So there's some definitely unique challenges depending on the marketplace that you're in. This is kind of another question, and if you don't have this or you don't want to answer this, that's fine. But Robert brought up the Fed raising rates 3/4 of a point today, which is the largest rate increase in decades on a single rate increase. What about your capital stack? What's going on right now on your acquisition side? Obviously, all three of us are configured differently in terms of how we take down deals. But do you have any comments or open, interesting maybe tidbits about what's going on out there on the debt, the equity, and what you're using to take down new deals?
Robert?
Yeah, I mean, absolutely. Like, so, and this is very fresh because we're closing this deal tomorrow. Look, your capital stack, your equity stack, they need to understand what it is you're trying to do. Ultimately, I'm here to make you wealthier. Now, as we said before, multifamily offers cash flow and it offers equity. That cash flow, especially like in Austin, is almost non-existent. This comes down to where I'm increasing the NOI. So while my cost to borrow that money has increased from the time I got in the contract to when we're going to close, it's reduced my cash flow. It doesn't impact my NOI. If anything, now I have to probably work harder and tighter to keep my expenses in line so I can afford the higher end debt service. But we're still going to hit our performance in terms of the NOI, which is ultimately the valuation. There's still heavy demand for multifamily because it's been the most stable asset class. Like during COVID, what survived? Netflix, Amazon, Zoom. But what do you got to have for all those to work? 4 walls and a roof. Now, what's happening now? You've seen Amazon, Zoom, and Netflix, they're hurting. We're okay. We're always going to be okay because people need somewhere to live. Even with the recession, as long as you had cash and as long as you had time, you were not going to lose money in 08, 09. You just need to make sure you have ample reserves right now to operate in, right? So I love multifamily. You just got to be disciplined. You can still buy deals. Just got to be disciplined how you buy them and explain to the stack, I'm here to increase your net worth. I'd love to give you cash flow. I love to be able to do those things. It may not happen immediately. I might have to grow into it, but I will for sure increase your net worth. So as long as you make that explanation clear to your group, they should follow you.
Nice. Travis, you want to add any of that?
Great points. I think that was a solid answer. Adequate cash reserves, fixed rate debt, yeah, that's good points.
And I want to add to this a little bit as I'm going to try and bring back that lens of Texas. One of the things that I'm noticing that's available in Texas, and I would venture to bet that both Travis and Robert, both of your companies are a little bit too big for this. But for anyone that's going to be listening to this now or in the future, if you're a smaller operator and you're talking about taking down those, 50 to 100 unit apartment complexes, and particularly for those that have a value add component, there are and this is really new, I'd say in the last 6 to 8 years, a lot of Texas regional banks have gotten very, very good at understanding these deals and working with smaller real estate investors, developers, managers to take those deals down. So that's something that I'm not seeing a huge repeat of. I do see a little bit of it in other places in the South that have a little bit of real estate experience. I've seen some of it in Tennessee, Georgia, Mississippi, but we're talking about small regional banks who are basically effectively acting like what I would generally see as a private lender, right? But they're not bringing private or hard money fees. They're bringing pretty nice fee structure, a takedown structure where they're giving me an interest only period for say 6, 9, 12 months while I do a renovation. And then as soon as the renovation's completed and I perform all the draws, it's turning into a 20-year fully amortized loan that's been stabilized. And all that's a single product. So that's kind of a new thing that I'm seeing in the capital stack are these regional debt providers that are kind of becoming a one-stop shop. So if you show up with some equity, the product is certainly out there for you. I can tell you that. I don't know if you guys have been seeing anything like that or akin to that lately.
Yeah, I don't have any comments. That's not something I'm familiar with.
Yeah, fair enough. No, it's okay. I think that's why they wanted a little diversity on the panel. So we got that. All right, let me ask you this then. Let's go the other way around. We love Texas. All three of us are investing in Texas. We're doing a lot of stuff there. But what's your challenge? Like what's hitting you at the knees right now? And you're thinking, oh man, there it is again. That's sure annoying. Like talk to me about that. What is your biggest challenge today?
I'll chime in with three things off the top of my head. Extremely competitive. You already pointed that out earlier, especially in the DFW market. High property taxes, of course, Robert pointed that out, and high insurance premiums, which we see in a lot of areas, but especially in Florida and Texas, at least with our portfolio.
Yeah, I think the other point that I'd make is, for sure, property tax and insurance suck, and we can protest them, and they're not operating costs, but they're there, and there's nothing I can do except stay on offense. In order to stay on offense, I got to have the right staff. That has been the biggest issue. I'm an owner operator. I have my own property management company. We've won, 19 city, state, national apartment association awards. I believe I do it better than others. That's why I won't third party. But I have holes. It's hard to find maintenance guys. It's hard to find property management leasing professionals. So it puts stress on everybody else to do it better. We're paying more for a guy that we never even would have hired 2 years ago.
Yeah.
Because there's not enough labor force. I don't know if it was an alien abduction. They call it the Great Resignation. That people, they never came back. I don't know where they're at, but they're not here anymore. And so it makes it very difficult to service the clientele, to deliver that kind of market leading service that I want to be known for if I don't have the team. So we've got to get more creative. We got to make sure that there's more avenues for the resident to communicate with us so we can know where we're failing and we can try to adopt and how we're going to get there.
Awesome. Yeah, I definitely agree with you guys on all of those points. The staffing issues for the team have certainly been something that we have felt. The insurance premiums have changed. That's definitely there. We're feeling that as well. There were a lot of claims over the past few years that I think the insurance companies said, we got to take a hard look at this. Taxes are always going to be there. We always know that's a pain where that is. All right, well, let's end on a positive one. If you had one area or a deal or something that's going on right now in your portfolio, what you're looking at, what's getting you excited? What's an opportunity that you're seeing in Texas multifamily?
I think just being able to take advantage of the job diversification that we talked about, an educated workforce, no state income tax. It's still relatively affordable depending on where we're talking about when you compare it to California, New York, and high tax states. Blue states, as Robert pointed out, a lot of people are migrating to the Sun Belt and to Texas. So I still think that there's a very bullish case that can be made for Texas and just for Sun Belt value add multifamily. That's my take.
Yeah, I think I would add that the one thing gets me excited is that having been in the cycle now for 15 years, right, is that I recognize these are just cycles, and when people are afraid and you don't want to buy deals, whatever, it's when you should buy deals. I bought deals in 2008. I bought deals in 2011 for $15,000 a door. We sold that later on for $90,000 a door, and I actually wish I still owned it. So the best time to get in real estate was yesterday. The next best time is now, because today, 10 years from now, you're going to think, wow, why didn't I buy that? So while it's a little up and down, if you have reserves, if you have time, get in the game. Don't look from the sidelines. You're going to wish you were in that deal. You're going to wish that you had control of that deal. Tell me in 10 years that I overpaid for the deal. Tell me in 10 years I shouldn't have done it. There are people telling me back in the recession, oh, it's too risky. Don't buy it. It was $15,000 a door. And there was all those naysayers everywhere. $20,000, $30,000, $40,000 a door. Naysayers, don't do it. Too risky. $80,000 a door for Class C crap. Now they're 110. It's what's happened. It's where it's going. This country, we've printed the money supply like there's no tomorrow. And today we're paying for it. Everything's going to be worth more in value. So if I can make a recommendation to anybody out there, get your money out of the bank making 0.0 nothing and put it into bricks and sticks. Put it into a hard real estate, a hard asset, and beat inflation. The best thing you do is that if you've been in this deal for 10 years and you've got one deal a year, you would have had 10 different checks coming in right now. How great would it be to have 10 checks coming in every month or every quarter? It's like being married to another person. And real estate offers that to you right now. You're looking at the stock market, people are going crazy, whatever, up and down. I lived that game 15 years ago. I'm done with that. I have not seen that in the real estate world. Just give yourself time, give yourself enough reserves. And if you're a passive investor, pick the right jockey. You don't back the horse, you back the jockey. You make sure you got the guy that's got a track record. You ask him the tough questions. Have you ever done a cash call? Have you ever lost money on the deal? Have you ever sold a deal? So many guys get into this business the last 3 or 4 years, and right now they're scared. Right? They're scared right now because they got to get out of that loan next year. So it's make sure you're with a quality guy or quality person, should I say, that has a track record, that has a proven track record, documented track record, and that they can take care of your money.
That's awesome. Good feedback from both of you guys. I like that. So just a quick reminder to those of you that are attending now, if you did have a quick question, throw it in the chat. I don't see any today, so I think we're probably going to start to wrap up here in a second. Maybe last final thoughts from either of you, and then also, if you desire, if someone wants to get a hold of you and talk to you directly, how do they do that? Or how do they learn more about you and your company? Would be a great way to close it up today. So Travis, back to you. If you want to let us know how they can do that and any final thoughts you have.
Sure. Yeah. Just one last thought off of Robert's points. It was, don't quote me exactly on this, but it's pretty close to this. 2007, right before the big collapse, right? Especially in real estate, average multifamily price per door, somewhere around 95,000, 100,000, somewhere in that ballpark. Today, over 200,000. So it just goes to show you, right? That was an all-time high. That was a peak. But if you were able to hold on and stick it out for the long term, then you're more than double up from that point. And so something to consider. If you guys want to connect with me on a one-on-one call, you want to learn more about Ashcroft Capital, you can go to ashcroftcapital.com/Travis. Check out current opportunities, things like that, if you're an accredited investor. Thanks for watching.
Awesome.
Well, first of all, guys, thank you so much. It's an honor and a privilege to be out here with this panel. You guys can find me on social. That's where I'm at. That's where I raise my equity. That's where I get my name out. If you don't already know who I am, I got to fire my social media guys because we're not working hard enough. But you can find me at Instagram at Apartment Rockstar. You can look me up on LinkedIn as well, or on Facebook, and we can just be friends. But it's hit me up at invest@rockstar-capital.com, or again, slide into my DMs at Apartment Rockstar on IG.
That's awesome. And before I kind of give a closing remarks, just a couple of plugs. Rodney talked about this earlier. Rodney working at Think Realty and AAPL. But we do have the Think Realty event in Tampa coming up. That's a 2-day event, and it's in July the 21st and the 22nd. I know that I'll be there. I think, Travis, you're going to be there because it's just down the road. Robert, hope you're going to join us too. You'll probably be too busy closing the deal. I know guys like you, so I get it. But yeah, that'll be Tampa. So please come out for that. And not exactly a selfish plug here, but I also chair the government relations committee for Think Realty, and we are looking for a couple of other members, and we'll be doing an update while we're there as well. So if you have any interest in legislative affairs as it relates to real estate investing overall, Think Realty has a committee that works on that. We do some really cool stuff, and I'm always interested to talk more about anyone for that. If you want to talk to me or learn more about what I do, you can find me at my website, chrisragland.com, or on Twitter at chrisragland. So that's it. I really appreciate you, Travis and Robert, for taking the time to join us today in your busy schedules. It's been awesome talking to you guys, and looking forward to talking to you again soon.
Thanks, everybody. I appreciate it.
Thanks,
Thank
everybody.
you.
Take care.